What happens to an episodic pivot or an earnings breakout after the earnings day is a very important thing. Because a lot of time on the earnings day, the stock makes a big move, but it doesn't follow through. And this is a very common thing because what is happening nowadays is that earnings news leads to a very big gap. And when news leads to a big gap, total move which the stock is capable of making gets priced in on the day one, and then after that, or it happens for 2 or 3 days, and after that the stock doesn't have anything left in the tank, or the stock just doesn't do anything. It just like it goes sideways, or it pulls back, or it just like for months it will not do anything, and then after that it has a delayed reaction. So this delayed reaction to earnings or a delayed reaction to an episodic pivot is a good setup variation which is good to trade in markets, current markets or the markets which are nowadays. In if you're trading say episodic pivot kind of a methodology 20 years ago or 25 years ago, this was not such a popular way setup kind of a thing, or earnings related strategies were not so popular. There were no algorithmic traders trading earnings or things like that at such an industrial scale like it is today. So today, if a stock comes out with an earnings, there are these news interpretation algorithms which immediately read the news as soon as it is released, and then can project how much the stock is going to go up, and that's why you'll see explosive moves in the after hours, and that is why a lot of trading in this kind of earnings moves has moved into after hours or pre-market. Now, let's look at some of the examples. What happens like when you get into a trade and nothing happens after that, and the trade just like and it doesn't do anything. And this is very common also on second or third EPs. The first time it works very well, but the second time it doesn't really happen that way. So let's look at like one of the things like Deckers is basically a earnings play which worked very well here. Now here there's an earnings, but on the earnings day itself the stock went up so much, 14%, and then after that it really didn't do much, and it's been doing nothing since then basically, and now it's this might be the delayed reaction kind of a thing. Another stock, IoT, had a very good earnings. Earnings day, stock makes a big move, right? Nothing happens, stock just like in a pulls back, then like in a pulls back, and then after months, the stock makes this move. So delayed reaction, and this stock has a history of doing that. Earlier also, it had big move, big gap on earnings, and nothing happens, and this can be very frustrating. And this is why you have to conceptualize and use this trade or look at this trade as a two-part trades. One part is what happens on the day of the earnings, and second part is what happens after that, and how to trade the second part of the move if there is a good catalyst. Another stock which is recently had a very good catalyst. The catalyst was good, but then what happened is that this particular stock on the day of the catalyst itself went up 56%. So when a catalyst is so strong and it goes up 56% on the day of the earnings itself, after that it hardly made much of a move. And then see yesterday it like and ended up almost reversing some of the gains. So this kind of a stock for this kind of setups, here also you'll see earnings was there. It didn't really, it did do well last time. This earnings, it just went up for 2-3 days, and so lot of these earnings related trades are going to fall into this category where they get priced in, or things get priced in one day, next tracker, right? And you see a big move happened, 2 days the stock went up, and after that nothing really happened, the stock went down, and now today there is an earnings on this, and it might go up a little based on that earnings again. So delayed reaction to earnings, delayed reaction, which is like, and you don't really, or you trade that stock on the day of the earning just as a 1 or 2 days trade because it makes such an explosive move, and then wait for a delayed reaction is a very good setup variation for episodic pivot. And in order to do that, the way you can uh, keep track of these stocks which had good earnings is to create some sort of a scan for stocks which reacted positively to earnings or which had good earnings, and then keep them in a watch list and continuously look for them for a delayed reaction. This also works very well. The delayed reaction works very well on the short side, because on the short side what happens is when there is a negative news, the stocks tends to drop significantly on the day. When it drops significantly, there are always these people who are going to cover their shorts, or there are people who are constantly buying weaknesses, or their core methodology is to buy stock which has gone down a lot, and then it bounces back. But after some days, the bounce gets over, and then the move starts down again. Let me show you an example of this MBLY. Now MBLY had a earnings which was like it missed earnings, guided down, but immediately it bounced, and 3-4 days it bounced, and after that it went down. So delayed reaction, episodic pivot on short side, sometimes you can get a second entry, like Accenture had this drop and then rallied, and then here offered you an entry. So keeping an eye on stocks which had episodic pivot, and those episodic pivots after they happen, after 5, 6, 7, sometimes after a month, they make the moves, and that gives you another second chance to make money from the stocks which had good earnings. So what I do is I create a watch list of stocks which has reacted positively for 1 or 2 days to earnings, and then keep an eye on them, keep an eye, and if they set up either as a short or set up as a delayed reaction, then I try and enter them as a delayed reaction. And this is becoming more and more frequent thing in this market in the current years. So delayed reaction EP is a setup variation of EP which offers you a lower risk entry, and delayed means like after a few days. Typically most of these stocks will give you an entry within next 10 days or 15 days of having an earnings. Like say you have this stock currently recently SG, which had a very positive reaction to earnings, but then again the stock went up almost 40% on the earnings day, and now the stock is not doing anything. So it might set up as a delayed reaction earnings. The volume was very high, and that kind of a stock is capable of making a second leg or a third leg kind of a move. Obviously you're looking for a second leg, you're not looking for a third leg kind of a move. So if you're trading episodic pivot or earnings reaction kind of a trading, look at delayed reaction setup as something to add to your arsenal, because stocks are having very large moves on the day of the earnings, then they go up for 1 or 2 days, and then nothing happens. So you trade that stock on the earnings day or on the EP day just as a 1 day phenomena or 2 day phenomena, and then wait for a delayed reaction setup. And some people might be better off not even trading it on the first day, because the first day moves are so fast and so difficult to get in. You need a wider stop, while the delayed reaction you're watching that stock, so you can get a better stop and you can get a better risk reward strategy. So delayed reaction EP as a variation of the EP is a good strategy to look at for those of you who already know what an episodic pivot is and are trading episodic pivots.